Oh no, I was not supposed to be recording today. I said I was done. I said the year was over. I said, go enjoy your families, close the charts, shut down the screens, pretend the world isn't on fire for 48 hours. And I meant it. I really did. I was off. I was gone. I had mentally checked out. And then this hit. And when something like this hits, you don't get to stay quiet. You don't get to pretend it can wait. You don't get to say, I'll talk about it next week. Because by next week, the price will already have moved, and the people who didn't understand what they were looking at will be standing there in shock, asking, how did this happen so fast? So I'm back. And if I sound agitated, if this feels rushed, if this feels chaotic, that's because it is. Something didn't move in the silver market. Something snapped. Not bent, not stressed, not stretched to the limit. Broken. What crossed my desk in the last 24 hours is not an opinion. It is not a forecast. It is not a technical pattern you can invalidate with a trend line. It is a structural failure. And once you understand what failed, truly understand it, you will realize that the market you thought you were watching no longer exists. This is not about sentiment. This is not about inflation expectations. This is not about the dollar index ticking up or down. This is about authority. This is about the exact moment when the paper price, the number on your screen, the number you've been trained to trust, lost control over the physical world. And when that happens, history does not rewind, it accelerates. I need you to do something right now. I need you to stop thinking like a trader. Forget charts, forget RSI, forget all of it. Think like a factory manager. Because factories don't care about narratives, they don't care about CNBC segments, they don't care what some strategist thinks fair value is. Factories care about continuity. Can I get the metal I need when I need it in the quantity I need at any price? And right now, across the world, that question is being answered with a terrifying silence. Because continuity is breaking. There are now two silver prices on this planet. Not metaphorically, not theoretically, literally. Two prices. One of them exists on Western trading screens. Futures contracts, ETFs, derivatives, and promises. Clean, liquid, infinite on paper. The other exists where silver actually changes hands, where it gets weighed, inspected, loaded, melted, consumed. One of these prices is convenient. The other is real. And the gap between them is no longer small. It is no longer ignorable. It is no longer something you can hand-wave away with temporary dislocations. The gap is so large that the machinery designed to erase it has stopped working. That is the alarm bell. Because in a functioning global commodity market, this cannot happen. It is not allowed to happen. Arbitrage exists specifically to prevent this. If silver is cheaper in one place and more expensive in another, capital flows. Metal moves, prices converge, that's the rule. Except they're not converging, they're diverging. Which means one of two things must be true. Either the smartest, greediest, fastest institutions on Earth suddenly forgot how to make free money, or the metal required to execute that trade is no longer available. There is no third option. And before you jump to conclusions, ask yourself something honestly. Do you really believe global banks, hedge funds, and trading houses are willingly leaving enormous risk-free profits on the table? Or is it more likely that when they reach for the metal, there's nothing there? Because here's the part that should make your stomach drop. When arbitrage fails, price is no longer discovered by traders. It is discovered by users, by whoever needs the metal badly enough to pay whatever it costs. And those buyers don't blink, they don't hesitate, they don't wait for pullbacks. They buy because the alternative is shut down. This is the moment when the market stops being financial and starts being existential. You are watching the transition from price management to price discovery, from convenience to reality, from we'll settle this later to give me the metal now. And once that transition begins, it does not move slowly. It lurches, it gaps, it shocks. People always ask, why does it feel like nothing happens for years and then everything happens at once? This is why, because systems don't fail linearly. They fail quietly, then suddenly. And the silence you're hearing right now, the lack of explanation, the lack of headlines, the lack of urgency in mainstream coverage, that is the quiet right before the snap. Two prices, one real, one fiction. And the fiction is about to be corrected. Not gently, not politely, not with advance notice. This is the kind of correction that catches people mid-sentence saying, there's no reason for, and then the screen updates. If you feel uncomfortable right now, that's good. That means you're paying attention. Because comfort is what paper markets sell you right before they fail. What you are about to see is not volatility. It is repricing under stress. And everything that comes next flows from the single fact. The paper price no longer has authority over the physical world. Once you understand that, everything else becomes inevitable. Let's start with the number. Because numbers don't lie, systems do. On Western screens, silver is trading around $71 per ounce. That's the number blinking back at you from New York. That's the number London confirms. That's the number sitting calmly inside your broker app, pretending everything is normal. $71? Clean, orderly, familiar. Now stop. Freeze that number in your mind. Because while you are being shown $71, another market, a market that actually takes delivery, is operating on a completely different reality. Let's talk about China. On the Shanghai Futures Exchange, physically settled silver contracts are clearing closer to $80 per ounce. Not hypothetical, not cash settled, not financial exposure, metal for money settlement, bars change hands. Inventory moves, warehouses empty. That difference, that nearly $9 gap, is not noise. It is not volatility. It is not a temporary dislocation. It is not some quirky regional premium. It is a fracture, a clean break between two pricing systems that are supposed to be inseparable. In a functioning global market, this is impossible. Prices are not allowed to drift that far apart. The entire architecture of modern commodity trading exists to prevent exactly this outcome. If silver is cheaper in New York and more expensive in Shanghai, the trade is automatic. Banks buy in New York, load the metal, ship it east, sell it in Shanghai, and pocket the difference. No risk, no opinion, no debate. That process, arbitrage, is the gravity of the market. It pulls prices together whether anyone likes it or not. And here's the part you need to understand at a gut level. Arbitrage is not optional. If a spread exists and metal can move, it will be exploited. Always, instantly, relentlessly. So when you see a spread this large, persisting, not for minutes, not for hours, but for days, something fundamental has broken. Because arbitrage doesn't disappear because traders get scared. It disappears because the trade cannot be executed. The metal cannot be sourced. The metal cannot be moved. The metal cannot be delivered. That's it. That's the list. This is the critical point most people are missing, because it requires abandoning a deeply ingrained assumption. The Western pricing system is built on the belief that physical supply is infinitely mobile. It assumes vaults are full. It assumes bars are unencumbered. It assumes logistics work on demand. It assumes inventory is always there at the right price if you're big enough. That assumption just failed, not gradually, not theoretically, practically. And the moment that assumption fails, the paper price loses authority. Because the paper price only works if it can be converted into physical reality on demand. The moment that conversion becomes uncertain, delayed, or impossible, paper stops being a price. It becomes a suggestion. What you're watching right now is not China overpaying. China is not paying a premium out of enthusiasm. China is not chasing a rally. China is not speculating. China is discovering the clearing price for physical metal in a constrained system. This is the difference between a financial market and a supply market. Financial markets price expectations. Supply markets price necessity. And necessity always wins. Think about what this means mechanically. If the Shanghai price is $80 and the New York price is $71, every rational actor should be emptying Western vaults and flooding Asia with metal. But instead of metal moving east, what we're seeing is something far more disturbing. Metal is disappearing. Inventory reports don't show replenishment. They show drawdowns. They show registered stocks thinning. They show delays, queues, friction. That tells you the bottleneck is not demand, it's availability. This is the point where denial kicks in. People say, it's just a premium. It'll normalize. Logistics take time. No, logistics don't stop arbitrage. Only absence does. If the metal were there, it would already be moving. The spread would already be closing. The fact that it isn't tells you that the market everyone thinks exists is no longer the market that actually exists. The Western price is still being set by leverage, liquidity, and derivatives. The Eastern price is being set by urgency and consumption. Those two worlds can coexist for a while, until they can't. And when they can't, the paper world doesn't win. Because you can trade contracts infinitely, but you cannot fabricate atoms. This is why the fracture matters more than the absolute price. A $71 price with physical availability is one world. A $71 price with physical scarcity is a lie. The Shanghai price is not higher. It is truer. It reflects a market where delivery matters, where failure to source metal has real consequences, where buyers are not optimizing for margin, but for survival. That is why the gap is expanding, not contracting. Because the Western system is still pricing silver as a financial asset, while the Eastern system is pricing it as an industrial input with no substitute. These two models cannot coexist indefinitely. One must dominate. And history is very clear on which one wins when supply is constrained. Once physical markets decouple from paper markets, the paper market doesn't slowly adjust. It snaps to reality. That snap is what people call a repricing, but that word is too gentle. This is a correction of authority. For decades, New York and London told the world what silver was worth. They could do that because physical supply was ample and delivery confidence was high. That confidence is now eroding. And when confidence erodes, paper pricing loses its anchor. You don't need a conspiracy for this to happen. You don't need manipulation. You don't need intent. You only need scarcity. And scarcity is now visible in the only place that matters: the inability to close an obvious arbitrage. That's why this is not a chart pattern. That's why this is not a trade setup. That's why this is not a headline-driven move. This is a system telling you, in the only language it has left, that the old rules no longer apply. Two prices cannot coexist forever. One of them will give way, and it will not be the one backed by physical metal changing hands. What you are witnessing is not China paying more. You are witnessing the moment when the world's largest industrial buyer stopped asking what silver should cost and started paying what it must cost. Everything that comes next flows from this fracture. Now here is where most people completely lose the plot, because when they hear shortage, their brains immediately jump to speculation. Traders, funds, hot money chasing momentum. That is not what is happening. This demand is not coming from hedge funds. It is not coming from retail traders. It is not coming from people staring at charts, hoping to flip a contract. It is coming from factories. And once factories panic, price becomes irrelevant. Let me say that again, because this is the core of everything. When industrial buyers panic, price stops being a signal. It becomes an obstacle to be removed. Factories don't buy silver because they think it's cheap. They buy silver because without it, production stops. And production stopping is not a drawdown. It's not a bad quarter. It's death. This is why what we are witnessing is not a rally. It is an industrial run on the bank. In a financial run, people rush to withdraw cash because they're afraid the bank won't be there tomorrow. In an industrial run, companies rush to secure raw materials because they're afraid the supply chain won't be there next month. And here's the brutal truth. Industrial runs are far more violent than financial ones because money can be printed. Silver cannot. Let's start with solar. For years, analysts told you not to worry about silver demand from photovoltaics. They'll thrift it away, they said. They'll substitute copper. Efficiency gains will offset demand. That narrative just collapsed. Solar manufacturers have hit the physical limit of silver reduction. The paste can't be thinned further without destroying efficiency. The physics doesn't care about price targets. At the same time, the industry is shifting toward higher efficiency cell architectures that require more silver per panel, not less. This is not a choice, it's a technological necessity. So you have a sector that dominates global solar manufacturing, realizing, all at once, that their future production requires more silver in a world where supply is already tight. That realization changes behavior instantly. When procurement managers understand that future availability is uncertain, they stop optimizing for price and start hoarding inventory. Not weeks of inventory, months, quarters, years. Because missing a shipment doesn't just delay revenue, it shuts down entire lines. Now layer on electric vehicles. This is where the urgency explodes. Next generation EV architectures dramatically increase silver usage per vehicle. Not marginally, exponentially. We are talking about an input that was once measured in grams, now being measured in hundreds of grams. Potentially kilograms, depending on design. That single shift changes the entire demand curve. And here's the part that should make you sit up straight. China is not just the largest EV market. It is the largest EV manufacturer. And it competes ruthlessly. When one major player secures supply, everyone else must follow or be priced out of production. This creates a feedback loop. One company hoards silver to protect future output. Competitors see inventories tightening. They hoard more. Supply vanishes faster than anyone anticipated. This is not speculation. This is survival behavior. Factories are not asking, is $80 expensive? They are asking, can we afford not to have metal? And the answer is no. This is why price elasticity disappears. A $10 move in silver means nothing when the alternative is shutting down a $1 billion facility. A $50 increase means nothing if it protects market share. Once industrial demand becomes price inelastic, the market changes character completely. This is no longer a price discovery process. It is a rationing process. The metal flows not to the highest bidder, but to the fastest and most prepared buyer. And that's why inventories inside China are collapsing. Warehouses are being drained, registered stocks are vanishing. Immediate delivery metal is being prioritized over future promises. This is where backwardation enters. Backwardation is not a technical curiosity. It is the market screaming. It means buyers are willing to pay more today than tomorrow because they don't trust future delivery. They don't believe the metal will be there. And when industrial buyers stop trusting the market to deliver, the market stops functioning as a market. It becomes a scramble. This is why Western analysts are confused. They're looking at charts. They're looking at currencies. They're looking at historical correlations. Meanwhile, Chinese industrial buyers are looking at production, schedules, and warehouse balances. These are two completely different realities. The West is still trading silver like a monetary asset. China is consuming silver like a strategic input. That difference explains everything. This is why silver is being pulled out of Western vaults and never returning. Once metal enters an industrial supply chain, it is effectively gone from the market. It gets embedded in infrastructure, technology, and products that won't be recycled for decades. This is not like investment demand, where bars can come back out when sentiment shifts. This is one-way flow, and the speed of that flow is accelerating. Every ounce hoarded by industry is an ounce removed from price suppression forever. This is the part that makes this moment irreversible. Speculative manias burn out. Industrial hoarding does not, because once a company secures inventory, they don't release it just because the price goes higher. They release it only if production ends. And production isn't ending, it's expanding. So you have demand that is rising structurally, supply that cannot respond quickly, and inventories being vacuumed into long-term use. That combination does not produce gentle markets. It produces violent repricing. This is why the Shanghai price is not blinking. It is not hesitating. It is not fading. It is not reacting to Western noise. It is reflecting urgency, and urgency is contagious. Once one sector panics, others follow. Once one buyer hoards, others must hoard. Once trust breaks, it does not come back easily. This is the industrial run, not loud yet, not on headlines yet, but relentless. And by the time the panic becomes visible to everyone else, the metal will already be gone. Everything after this point is downstream of that reality. The fracture you saw in Section 2, this is the force widening it, and it does not slow down on its own. Now we turn the camera back west. And this is where the story stops being abstract and starts becoming dangerous. Because while everyone is staring at prices on screens, something far more important is happening quietly, methodically, without drama. The metal is leaving, not rotating, not being reclassified, not being temporarily allocated, leaving. Western vaults are being drained, not in a single spectacular event, but in steady, relentless withdrawals that tell a very specific story if you know how to read them. This is not panic selling. This is not speculative repositioning. This is possession. There's a difference between owning silver on paper and taking delivery of silver in reality. And right now, the entities with the most information are choosing reality. Registered inventories, the silver that actually matters, the silver that can settle contracts, are thinning at a pace that should not be possible in a market that is supposedly well supplied. This is where the illusion starts to crack. Because Western markets are built on layers, eligible, registered, allocated, unallocated, claims stacked on top of claims. Most people don't understand this, and frankly, they were never meant to. The system works as long as most participants never ask for delivery. But what happens when they do? What happens when metal that was assumed to be available is suddenly spoken for? What happens when a bar that exists in a database is no longer sitting where it's supposed to be? And that's when you start hearing words like delay, processing time, administrative backlog. Those words are poison, because in a digitized modern vaulting system, metal should be instant. Serial numbers should be known. Ownership should be clear. When retrieval slows down, it doesn't mean the computer's broke. It means the metal is not where the system assumed it was, and that is the moment when trust evaporates. Here's the paradox that traps the Western system. The arbitrage spread we talked about earlier creates a massive incentive to move metal east, but the very act of responding to that incentive drains the inventory required to keep the market functioning. Every ounce that leaves a Western vault reduces liquidity. Reduced liquidity increases volatility. Increased volatility widens the spread. A wider spread pulls more metal out. This is a feedback loop, and feedback loops do not resolve gently. This is why the situation accelerates instead of stabilizes. Banks understand this. Vault operators understand this. Logistics firms understand this. That's why behavior changes quietly first. Bars stop being offered freely. Settlement times stretch. Large allocations become case by case. No press releases, no announcements, just friction. And friction is fatal to paper markets, because paper markets rely on smoothness, on confidence, on the belief that delivery is boring and guaranteed. Once delivery becomes interesting, the game changes. Here's the part most people don't want to hear. The Western silver market does not function on full backing. It functions on confidence that backing exists if needed. That confidence is now being tested, not by retail, not by conspiracy theorists, by industrial demand on the other side of the planet. And industrial demand does not negotiate. This is why metal is flowing in one direction. Once it leaves Western vaults and enters Eastern industrial supply chains, it does not come back. It is melted. It is processed. It is embedded. Gone. This is not like ETFs, where metal can be redeemed when sentiment turns. This is permanent removal. That's why each withdrawal matters more than the last. This is also why suppression mechanisms fail under physical stress. Paper selling works only if physical supply stands behind it. Once that supply thins, every paper short becomes dangerous. Because if the counterparty asks for delivery, and delivery cannot be met immediately, the illusion collapses. This is where Western markets are most vulnerable. They are not designed for synchronized delivery demands. They are designed for offsetting positions, rolling contracts, and netting exposure. They are not designed for a world where buyers don't want exposure. They want metal. And that shift is happening quietly, without headlines, without retail participation. It's the worst kind of stress. Now add timing to this. Low liquidity periods amplify everything. And when senior traders are away, when desks are skeleton crews, when order books are thin, the margin for error disappears. In those conditions, it takes very little pressure to cause outsized moves. And here's the nightmare scenario for the system. A large buyer demands delivery. Inventory is insufficient. Paper sellers hesitate. Liquidity evaporates. Price doesn't rise gradually. It gaps. That's how resets happen. Not because everyone suddenly agrees silver is worth more, but because there's no metal available at the old price. At that point, price is no longer negotiated. It is discovered by whoever is willing to sell the last available ounce. And when inventory is razor thin, that price is never polite. This is why the Western drain matters more than the Shanghai premium itself. The premium is the signal. The drain is the mechanism. One tells you there's a problem. The other tells you it is already underway. This is also why denial is so prevalent. People want to believe inventories are still fine, that stocks are historically adequate, that everything will normalize. But normalization requires replenishment. Where is the new metal coming from? Mines cannot ramp overnight. Recycling cannot surge instantly. Strategic stockpiles are being drawn down, not filled. There is no cavalry. So the system does what all systems do under stress. It hides weakness until it can't. Then it breaks suddenly, publicly, and violently. This is why watching vault movements matters more than watching price ticks. Price can be manipulated. Inventory cannot. And right now, inventory is telling a story the price has not caught up with yet. The West is not losing metal because it wants to. It is losing metal because it has to. Because the alternative is default. And once a system reaches the point where metal must leave to prevent failure, the end game has already begun. Everything after this is just timing. The drain continues, liquidity thins, confidence erodes. And when price finally reacts, it won't be because someone changed their mind. It will be because there was nothing left to sell. This is where everything converges. Not gradually, not politely, all at once. Because markets can pretend for a long time, but they cannot pretend forever. What you're watching now is not a rally forming. It is not a squeeze beginning. It is not speculation overheating. It is a reset of authority. For decades, the silver market operated on an unspoken agreement. Paper prices would lead, and physical reality would follow. Futures markets would set expectations, and the metal would flow where it was needed at those prices. That agreement is now void. Not debated, not renegotiated, voided. Because authority in any market comes from one thing only, the ability to deliver. And the moment delivery becomes uncertain, authority transfers instantly, whether anyone acknowledges it or not. This is why the paper price is no longer leading. It is lagging. It is reacting to a world it no longer controls. The Shanghai price is not aggressive. It is not emotional. It is not speculative. It is clearing. It reflects the price at which real buyers can still secure metal in size. And here is the hard truth that most people are still resisting. Once the paper price is forced to meet the physical price, it does not go back, ever. Because once the illusion breaks, trust does not magically return. When market participants realize that metal availability is finite and delivery is not guaranteed, behavior changes permanently. This is the psychological shift that defines resets. For 30 years, global industry operated on just in time. You didn't hoard, you didn't stockpile, you trusted the market. That trust is now gone. We are moving into just in case, and just in case destroys paper pricing models because it replaces optimization with redundancy. Instead of asking, what's the cheapest price? Buyers ask, what's the safest supply? That question has no upper bound. This is why $80 is not resistance. It is recognition. It is the first price where physical scarcity begins to be acknowledged, not resolved. And once that acknowledgement happens, the logic becomes brutal. If silver at $80 does not destroy demand, price must rise. If silver at $80 does not create supply, price must rise. If silver at $80 does not restore confidence, price must rise. There is no third path. This is why the idea of mean reversion is dangerous here. Mean reversion assumes equilibrium exists. Equilibrium does not exist when inventories are being consumed faster than they can be replaced. Equilibrium does not exist when demand is inelastic and strategic. Equilibrium does not exist when supply responds on a decade-long timeline. So the market does the only thing it can do. It reprices upward until something breaks. Either demand is rationed or capital floods in to fund new supply. Both require much higher prices. And this is where people make the biggest mistake. They anchor to old numbers. They think $30 was expensive. They think $50 was extreme. They think $80 must be insane. That thinking is obsolete. Those numbers were formed in a world where paper suppression worked, inventories were ample, and trust was intact. That world no longer exists. In a world where silver is a strategic industrial input, price is no longer measured emotionally. It is measured functionally. If silver adds $100 to the cost of a $50,000 product, demand does not collapse. If silver adds $200, demand does not collapse. The metal is too critical. This is why silver is dangerous to short in a physical shortage. It does not behave like a luxury good. It behaves like infrastructure. And infrastructure pricing does not respect technical ceilings. Once the reset begins, volatility explodes. Not because the market is unstable, but because it is relearning reality. Expect violent moves. Expect pullbacks that feel like crashes. Expect headlines screaming bubble. Those are symptoms of transition, not reversal. The market is not asking permission anymore. It is repricing fast enough to catch up with years of distortion. This is also why the reset does not end at convergence. When paper prices finally align with physical prices, something new happens. Investment demand wakes up. For years, investors were told silver was dead money, manipulated, too risky. But once they see that suppression no longer works, once they see physical scarcity asserting itself, capital flows change direction. Pension funds, family offices, sovereign entities, they don't chase tops. They chase regime changes. And this is a regime change. Because once paper loses authority, it never regains it. The system cannot reassert control without metal, and the metal is gone. This is the part that most people won't understand until it's over. The reset is not a moment. It is a phase, a prolonged period of price discovery where volatility replaces suppression and reality replaces convenience. Silver will not move in straight lines. It will shock higher. It will flush lower. It will feel untradeable. That is what real price discovery looks like. And through all of it, one thing remains constant. Physical silver becomes harder to get, not easier. Premiums rise, delays lengthen, availability shrinks. At that point, the screen price becomes almost irrelevant because you cannot buy what does not exist. This is why the reset is final. Once scarcity is visible, behavior changes permanently. Once behavior changes, supply chains restructure. When supply chains restructure, price never returns to its old regime. That's why this moment matters. Not because silver is going up, but because silver has escaped the system designed to control it. This is not the end of a cycle. It is the end of an era. And from here forward, silver will be priced not by promises, but by possession. Not by leverage, but by necessity. Not by what traders think, but by what factories require. That is the reset. And it does not wait for consensus.